we're speaking now with Manas Agrawal, Vice President Research Analyst at Sanford C Bernstein. Manas, a very good morning to you and great to have you on. Now, two notes that you're talking about and 2 points of view. One, of course, on AMCs and one on insurance companies. Let me start with your take on insurance companies, which have been seeing a lot of buzz for various reasons. One is the expectation that GST on insurance will come down. The other is that the surrender value issue, at least for the life insurance companies, will sort of be eased. But what is your fundamental reason for being bullish on Indian insurance companies?
Sure. Good morning first, and thanks for having me here. I think the mentions that you made around GST and surrender value, GST is smaller issue, not really driving my view. My view is more long term. I think there is an adoption-led growth that the insurance industry and the mutual fund industry should have and will have, in my view. That drives your long-term growth. Surrender value issue is probably, at least in my view, the last known regulatory issue. People were fearing a large impact. Companies have come out and guided, at least, for a smaller impact on their margins. We'll have to see how that pans out. I think growth is coming back into the sector after a couple of years of regulatory flux. So all in all, pricing or valuations for life insurers are attractive and the long-term growth story remains. So that's what builds my view on life insurance, on asset managers. We've seen fantastic flows from households into the industry. Markets have been very kind as well. So mark-to-market gains are driving AUM growth and profit growth. I think more of that will continue in the long run across the cycle. I think household exposure to equities is very low and it will only continue to go up in the medium term, long term. That's how I think about these businesses on a long-term basis. I hope that answers the question.
Manas, let's talk about what is happening right now, right? With more awareness, with more education, literacy, investors realize that the best way to build their portfolios is to keep insurance separate from equities or investments, right? And that's probably the right way for any country to go about in the medium to long term. What we've seen recently is that ULIPs are the key contributor in terms of revenue for insurance companies. Now, I do understand these are not high margin businesses, but they've done a good job in terms of the revenue. So my limited point here is that if we are moving towards a country which should keep insurance and investment separate, ULIPs will fall off the handle, I'd imagine, right? What happens then? Shouldn't it be an either or as opposed to a both when you look at insurance and equity or asset management companies in that sense?
Sure. So the fundamental point you're making, I can agree with that. But then customer awareness and understanding of these products, especially insurance, is very limited, right? About 4-5 crore people in India have access to mutual funds at this point in time. A similar number has access to insurance from a private player perspective. I'm removing LIC over here. LIC is predominantly a par product story. So yes, ULIP may not be the right product to gain equity exposure, but then that awareness is more present in financially savvy people like you and me. And the average person does not necessarily understand this factor. So it'll be a gradual shift. I don't think it'll be an either or overnight or in 1 year. That will happen till the time markets do well in the near term. ULIP sales will be higher. Insurers are also cognizant of this fact and they have an active push away from ULIPs at the margin, trying to push more non-par products and more annuity products and more term products, which are also margin accretive for them. So answering your question, yes, you're right, but then it will be a gradual journey. And this year, ULIPs will continue to do well, given how markets are.
Manas, let's come to what you like in this space. And I'll come to non-life and then to life. You are saying HDFC AMC is outperformed. Nippon is as market performed. And you're preferring HDFC AMC to Nippon. Why is that?
Sure. So the only reason behind that is the level of cyclicality in the business that I'm seeing. The way I am thinking about it, these stocks and the broader India market is not cheap at this point. We can debate whether it's costly or it's fair price. And my view is it's more towards the costlier side. So because asset management industry itself is cyclical, because mark to market forms a very big part of their AUM movement. And then within that, HDFC AMC, lower exposure to mid cap, small cap, multi cap funds, higher exposure to hybrid funds. So if and when markets turn, Nippon will probably see a sharper downturn in stock prices than HDFC AMC. So that's the only reason. Both companies have fantastic performance tailwinds. Both are gaining market share. They both benefit from industry tailwinds in terms of SIP flows continuing to be strong. So it's only a valuation or a risk call. From a fundamental perspective, both businesses are doing very well.
Also, Manas, your note talks about how, distributors also stand to gain significantly, and maybe there are no biases there, no loyalties. They can sell whatever sells, really, right? But your recommendations don't feature any distributors except PB Fintech, which I'll talk about in a minute. But anything else in the distribution platform that you like, any wealth advisory firms that you like? Because the likes of an Angel One and Uvama and Edelweiss, 360, while they manufacture products, they also have a pretty active distribution arm.
Correct. So that's exactly the reason they don't feature in the set, is because I don't cover the names actively. From a value chain perspective, if you see, what works for them is they get a percentage of AUM as their revenue, similar to asset managers. And as you rightly pointed out, they diversify their client holdings across various fund houses and various asset classes. So even if a particular asset class or a particular fund manager does not deliver returns, it is possible that the client portfolio returns are not that bad. So performance risk that is attached to an asset management stock is lower for the distributor for that reason, and revenue model or growth is similar. So that's the point that I'm trying to make in my report, that if you have a positive view on the mutual fund industry, they may be a good way to express that positive view. I don't cover those names, and therefore you don't see that in my preference list.
Fair assumption is, Manas, over the next couple of months, you may add coverage to those stocks as well, because you can't not cover them, especially because you're constructive on the distribution space. Also, very quickly, in the insurance pack, I realize that you don't have any biases, right? Private insurer players, public insurer players, life versus non-life. You want to quickly just take me through that? And also, these stocks have already ran up significantly. How much more upside from here is the question, and what is the time horizon we're looking at?
Sure. So just to confirm, I cover only life insurance. I don't cover general insurance at this point in time. And then the preference within life insurance is towards private life insurers who have a good distribution franchise in terms of their parent bank support. So the top pick is SBI Life. I also like HDFC Life and Max Financials. In terms of these stocks running up in the few months and weeks, yes, they have. But then if you take a longer term view, they've been laggards because of regulatory issues, which have plagued the industry over the last 2-3 years. I think there is valuation support, and I think regulatory issues, at least known issues, are behind us, largely priced in. So there is upside in my mind on the life insurers. That's how I'm thinking about it. I don't cover general insurance, so won't comment on that.
And LIC, lion's share still of the market, lagging behind and losing that share consistently, but even so, as a business, you're not too constructive on LIC?
Sure. So I think since listing, the management has become far more active in terms of product launches, trying to change the product mix and improve the margin profile. They've seen good performance on the back of that as well. It's now at that point where I think all the efforts will not necessarily change the growth trajectory. I see margin upside from product mix, but then they are also going to face product level margin pressures, and they are now trading at 1x embedded value. So defining further upsides, I think I would like to see more conviction in my mind on improvement in product level margins. And the other is how do you change the growth trajectory? Those are 2 points where I'm not as convinced, and therefore a market perform after the run up that we've seen in the stock.
One platform, one distribution that you cover is PB Fintech, who again had a good dream. It's had a dream run, right? You can't be complaining. Where from here on PB Fintech?
Sure. So I think on a business model basis, I like distribution in the insurance construct more than the manufacturers or insurers. I think distributors extract more commissions. All of it is upfront, so very little operational risk. Uh, Fantastic business model exposed to high growth segments in online, high growth segments in pull products or like term and health. So the growth story has been fantastic. I think they are going to deliver very strong growth on the business volumes or GMV. That will translate to revenue as well. Economics on the margin side are improving. So taking a positive view on the business model, run up a fair bit. It's close to my target price now. So I think Q2, Q3, they'll deliver higher growth than what people and me are penciling in. So probably near-term upside, but then valuations are stretched. So difficult to really wrap your head around long-term, medium-term upside. Long-term, I think the business will make money, but you'll need to be patient around that.
All right. Thank you so much, Manas Agrawal. They're talking about the capital markets play as well as the insurance play right now. Manas, great to speak with you, and thank you for all your insights.